Welcome back to another episode of Wake Up Call. Before we get started, please like, share, and subscribe to Onramp media channels to receive the best Bitcoin education and content in the industry. And also be sure to check out our latest research report called Bitcoin, the Emergent Asset Class Has Arrived, a three-part series aimed at introducing important Bitcoin-centric concepts to the institutional allocator world. Part 1, available now and linked in the show notes, explores Bitcoin's volatility and why it is a uniquely desirable characteristic of the asset that can boost returns and dampen overall volatility in traditional portfolios. Wake Up Call aims to educate financial professionals on the merits of the Bitcoin investment thesis, how this asset class represents both a threat to legacy financial services businesses and an opportunity to differentiate oneself to retain and attract new clients. Hosted by Mark Connors, Onramp's head of global macro strategy, and Rich Kerr, Onramp's president of managed wealth, this weekly show seeks to provide financial professionals the wake-up call they need, prompt them to have an open mind with respect to Bitcoin, rethink their prior assumptions, become more educated on the topic, and learn from others who are already farther down this path. Wake Up Call is live streamed on LinkedIn every Monday morning, and the recordings can be found across Onramp media channels. Now, time for the show.
Well, good morning, everybody. Happy Monday. Thank you for joining us on Wake Up Call. This should be a real special show today. We are delighted to have Jennifer Murphy, who many know as a 30-year TradFi vet in the asset management space. And Jennifer, your experiences at Legg Mason and Western Asset Management and now leading Runa Digital Assets, it's just awesome. We're delighted to have you today. And before maybe we kick off, we'll kick it over to my co-host, Mark Connors. Let's talk a little bit about what's going on in the world that's got your attention.
All right. Well, thanks for that, Rich and Jennifer. We're really excited about ripping it up with you today on we talk about being bilingual, about the person who brings that history of traditional finance and then why and how you ended up focused on digital. And some of the news points suggest that we're going to be on the right side of history here because some of the players are getting loud in TradFi. Microsoft, which we will talk about later, because that's one of the pieces in some of your foundational research about the arc of revolutions in technology that have driven value. Microsoft stated that, or filed that they plan on voting on whether or not to add Bitcoin to their balance sheet. You know, people say it wasn't on their bingo card. Certainly, it's not a slam dunk. The board is against it. Shocker, right? They want to add value. They don't want it to come from a decentralized commodity that they had nothing to do with. So, you know, we understand incentive structures drive a lot of value or a lot of attention and innovation, and the shareholders apparently want it. So we'll see. The reason that's relevant is because one other company that added, as we all know, is MicroStrategy. And MicroStrategy was lagging Microsoft for decades until they added Bitcoin. And now MicroStrategy's 20-year compounded return is 21%, and Microsoft's is only 17%. Now, 17 is a good number, but it just shows you the power of this, of adding Bitcoin to the balance sheet. So front and center, that ranks up high. And the other one, which we'll pull on from the investment side, has to be Paul Tudor Jones. When he said, all roads lead to inflation, I'm long, Bitcoin, I'm long commodities. I don't own bonds. And if nothing, he can really pick out those regime shifts. I mean, 87, he was there when, before Black Monday, kind of made some money on that trade. And then the rest is history. So my ears perk up when he says all roads lead to inflation. And then just the divergence in markets is pretty legion right now. You have a lot of commodities dropping. You have oil down. You have, Europe going to single digit / fractional growth, less than 1% GDP expected, yet inflation's almost 3% there. So tough spot there. You have equities hitting all-time highs. You have bonds in the basement, down month to date. Some of them are down over the past 1 year and 5 years and 10 years as far as longer dated bonds. So kind of a mess all around. But the one thing that's there is low growth and inflation. It means that central banks may have lost the plot or the ability to manage the economy effectively like they used to. So the last thing I'll say before I hand it back to you all, and also poke at some of the things I spoke about in case you want to add anything, is in credit, you're seeing high yield and investment grade have almost no distinction. Historically, it's the lowest spread between high yield and investment grade that we've seen in the last 5 years and almost the last 30 years. It's the tightest spread since 2007, which, if memory serves, was right before a little bubble pop. So no one is thinking there's a problem in credit, yet on the treasury side, volatility for treasuries is in the top quartile over the past 10 years. It's like a VIX at 40. It's just, it doesn't make sense in the brain, except the government has assumed so much risk and the buyers of treasuries have walked away. So it's not unusual to expect that there's going to be kind of pushback. The reserve tank is blowing out. No one's going to be buying treasuries, or more people are walking away. They're buying gold, all-time high. So that's the market we have right now. We have low growth, we have regional distinctions, we have market asset class distinctions, and we have Bitcoin just racking up good news and returns along the way. So I know it sounds a little too bullish to believe, but I'm data driven as you are, Jennifer, and we're going to go through some of the work you've done. Look forward to it. And why don't you, Rich, kick off or give it to Jennifer, how you guys want to proceed
Yeah,
here.
maybe you just kind of jogged my memory. I believe it's 95 years ago today that the stock market dropped 12% on a Monday, and then came back the following Tuesday, Black Tuesday, which dropped an additional 15%, if I remember the math, and led us into the Great Depression. And so I don't want to be bearish or anything of that nature. I don't want to forecast. That's not what I do. But it is an interesting period of time. And Mark, you were just going over some very interesting insights into bonds and how they played out in 1987 or in 2007, 2008, and so interesting period of time, and we'll see where everything kind of goes from here. But I had mentioned kind of just briefly, how excited we were about having Jennifer join the show today. I mean, CEO of Legg Mason Capital Markets, and what a tremendous distinction that is. But what I didn't provide color on is she also has quite an academic background, a CFA. An MBA from Wharton. She is just, a wealth of knowledge, but also a leader in the space that helps kind of shape where the industry is going. And 5 years ago, I believe you kind of made the big journey into the digital asset space. So might be a good time just to share a little bit about your career arc, because it really is quite exceptional, and you've come across some amazing people in your own right in your journey. And so I'd love to kind of hear and share with the audience a little bit about who you are and what you're up to these days, Jennifer.
Great, Rich. Mark, thanks for having me. In 1997, I was working with Bill Miller, who was also my first boss. I had a couple of other jobs in between coming back to work with Bill. But in 1997, I was working with Bill Miller, who I know you both know is a very, one of the world's best equity managers. At that time, he was, I think, 6 or 7 years into a streak of beating the market, which he would do for 15 years straight, which no one's ever come close to. I think the closest streak before that was 8 years. But interestingly, he was a value manager. That's how most people would describe him in the time, as you both know, in the late 90s was the internet, what eventually would be called the internet bubble, And I think one of the most interesting things about Bill is he, as a value manager, kind of rejected this Warren Buffett idea of, I don't understand technology, so I'm just not going to invest in that. And he really waded in. He met with Jeff Bezos when Amazon was going public in 97. He sat down with him and really wanted to understand what Jeff had in mind. And that was back when you could still do that, as a portfolio manager. And what Jeff described to him was not what he heard from other people. He described a global e-commerce platform, and sort of a focus on capital allocation. If you look at a lot of people like to refer back to the Jeff Bezos 1997 IPO letter. And if you read his letter, it's sort of a tour de force in how to think about capital allocation. I think people recognize that now. But at the time, you have to get to page 3 before he even says the word book, whereas back then, when during the IPO, most people would describe Amazon then as a bookseller, and analysts would view their potential as, well, how much of the book market can they take from Barnes and Noble or, other booksellers? So what Bill really focused on is the description. Is that the right description of Amazon as a bookseller? And his conclusion was, no, Amazon's a global internet, sales platform, and maybe more than that. And here's their CEO is incredibly focused on capital allocation. And so I think those two insights from Bill of the description matters, and he's a philosophy PhD student, so he would put up slides in front of our clients quoting Wittgenstein and other philosophers about how important description is, and and it worked. Bill could make that work. But I really took from that how you describe something matters a lot. And so sort of fast forward to Mark and Rich, things I know you're well aware of. But when Jamie Dimon calls Bitcoin a pet rock, is that a good description of Bitcoin? Absolutely not. So you have sort of that, and you have people like Larry Fink and Jenny Johnson at Franklin Templeton and Abigail Johnson at Fidelity. Their description of Bitcoin is a global financial asset. Their vision is its total addressable market is the global financial market. Those two differences in descriptions matter a whole lot, right? That's a dramatically different outcome. So I think one of my great gifts of my career and what really set me on this arc was really Bill's, insistence on always sort of going to the root of the matter, going to the data, as you said, Mark, but also to important concepts from history and really applying them without being relegated to, well, value investors can't buy technology.
Wow.
Yeah, this is something, Jennifer, that Rich always brings up or often brings up is the anchoring. We're smart people, the advisors are disruptors, but in that Kahneman Tversky book about thinking fast and slow, and what reminded me is when you said Bill Miller was a student of philosophy. I mean, we love data, but variations on a theme don't get you to the next one.
Mm-hmm. That's right.
And you have to step back sometimes and bring on people like you who've done work and say, wait a minute, this has run its course, or we have to rethink and reimagine. And the description that you bring to it, that you mentioned Bill did, that got you thinking differently. That's what we're trying to do here. I mean, we didn't really know we're trying to do that until we said, wait a minute, it's exactly what we're trying to do.
No doubt.
Yeah, I mean, he brought a similar sort of insight, I think, to Google in its IPO. It was, you probably remember this, but Google went public in 2004. This is after the internet bubble burst. The exuberance was gone. There was a lot of skepticism, and you remember Sergey Brin, and they didn't want to do evil, so they wouldn't use an investment banker. It was a Dutch auction to try to level the playing field for the little guy. So it had all these weird aspects to it from the point of view of a TradFi firm. So the initial price talk was $1.35 a share. It ended up coming at $85 a share, which was a $23 billion valuation. And because of all these obstacles, as it turned out, only 2 institutions bought Google on the IPO. That was my boss, Bill, and Fidelity, the Fidelity portfolio manager. And the rest was, retail investors. So that seems incredible now, given that, Google is now 20 years later, a $2 2+ trillion dollar company and one of the great, most valuable companies in the world. But at the time, it was described as a search company that had a lot of competition. It wasn't clear how they were going to monetize it, their user base. And I think that whole idea of network effects, Bill was already talking about those things, about the power of networks and how networks have such important attributes. And there was a lot of work being done by people like Duncan Watts, who wrote the book 6 Degrees. That whole idea of 6 degrees of separation, that comes from that. I think that whole idea of the power of networks is very non-intuitive. And in essence, the idea is that the value of networks grow faster than the network grows itself. Its value comes from the growth in participants on the network. So I think Bill was sort of focused on that early and persisted with it, whereas I think most people are still 20 years later today. I think if you ask most people to describe network effects other than you two and maybe some of our peers, they would have trouble describing it. Still not a familiar concept.
So actually, this is fascinating. So those are really powerful early lessons in your career, right? And I'm certain that those have stuck, with you, but maybe share with our audience, how that's, kind of stepped you into the digital asset space, and then maybe what you're seeing with Bitcoin in particular, because I think largely most of our audience is pretty focused in that space. But I would love to hear some of your thoughts and how those lessons in your career have stayed with you as we're watching this massive transformation happen right in front of us.
Well, I spent a lot of time, working with Bill directly, and then when he retired or went off to do his own thing, I sort of continued on. So I worked for a long time in equity asset management, and then in fixed income asset management, in many roles, some financial, some leadership roles. So I have many different seats, and but all the while, sort of following this sort of Bill approach of heavy reading, heavy thinking, listening to podcasts, people like you talking about things broadly. So when I was at Western Asset, I was the chief operating officer there. I was reading about blockchain and thinking, this sounds important, but I don't know. And I asked our technology team about it, and they were very skeptical, which I find is common when someone is really knowledgeable about something. You can really see the flaws, right? So the technology team was very cognizant of a lot of this stuff has been around for years. These are just databases, they're ledgers, it's not revolutionary, So they had a lot of skepticism. And correctly, they believed it would take a long time. That was true. But what was interesting to me was our operational team brought it to me. So Penny Morgan, who at the time was in a leadership role in operations with me, she came to me and said, we should be doing more with this. We could collapse our infrastructure with this technology. So we started working with the support of our CEO, Jim Hirschman. We started working on applications that were developed. They were sort of written for us by IBM and using their proprietary blockchain software. And we actually developed and implemented those applications and demonstrated that they could work. So proof of concept. And Western, with JP Morgan, even though Jamie Dimon says bad things, they do a lot of positive things. We bought the first bond that was issued on a blockchain infrastructure from the National Bank of Canada through JP Morgan. Western was the buyer of that. And it was so interesting to me because we had been talking, the business and operations team to the investment team about why we thought this was important. And they were like, okay, maybe. But what was interesting was when they did the trade, on the blockchain platform. So this was a new issuance. They did the trade, and everything settled and updated. Everything happened instantaneously. And that was the first time they walked out of that room and they said to us, this would change the whole way we manage our accounts. I was like, yes, exactly. That's right.
And
Well,
this is 2018, if I'm
yeah,
not
yeah,
mistaken, right?
that's right.
So you're
But was
talking
that a
six
good thing?
years ago.
Did they take that as a good thing or a scary thing?
Definitely a good thing. They definitely
Okay,
saw
good.
potential of it. And but it was interesting that we could tell them about it, and that wasn't very effective. And when as soon as they did it, they used it, then they were telling us, what would happen if this infrastructure, came to pass. So that was a powerful lesson for me that really people do really need to experience these things to really, incorporate them. Most people need that. So that was when, so to sort of bring this to a close, Rich, sorry I'm taking too long, but I started thinking, in several years ago, this is going to transform. It's certainly financial services infrastructure. Bitcoin looks like it may be among the most important assets going forward for investors. And what am I doing? I have a front row seat to all this, and it's happening right now around me. And I have my partner Max Williams is equally committed to these ideas, and we thought we gotta try. We have to leave these comfortable roles in traditional finance. He was at Nasdaq, and we need to dive in here. So that's what we did. You're on mute there, Rich.
We're a bunch of 30-year TradFi refugees sitting here on the internet talking about something that has got us really, really energized about the future.
Yeah.
And thankfully, in many respects, like I constantly am grateful that I was able to fight past my own. I don't know what it was. Maybe my indoctrination into traditional finance. It
Yeah.
was such a struggle for me to break that and actually get intellectually curious and see what kind of lived behind Bitcoin in particular for me. And I was one of the naysayers and spouting FUD, and then all of a sudden here I am, completely on the other side of the fence, because I think once you really start, speaking with people like yourself, Jennifer, and Mark, and you start doing a little bit of research and you're looking at the world and you're like, oh my goodness, this is a really, really tricky landscape for an individual investor, let alone a registered investment advisor, to be able to think about how do I really do well by my clients, because this is going to be a transformation in the financial services industry, let alone other industries, by the way. But it will be a significant transformation that requires, some rethinking of things that I thought I already knew. And so, here we are today. It's a pretty interesting world, and I am just unbelievably grateful to have found Bitcoin. I'm very optimistic about where the future is going to go. And maybe I'll table it. I want to talk to you a little bit towards the end about how you see the future. And you've seen a lot of significant changes in your career and led a lot of those changes. And so I think it's going to be an exciting show to kind of let it unfold. So sorry for the aside, but I just had to say that.
So, Rich,
Oh, sorry, go ahead.
I was going to lead us into Rich wants to land the plane saying, where are we going, right? It's just like, let's open the presents up now and see what we
Yeah, I'm
got,
like the kid at Christmas. I'm
which,
so
which
excited.
I love. I love that. But go ahead. I'm gonna bring us basically, Jennifer, I look at you like an iceberg, which is one of the highest compliments I can pay to someone. You show this much and then just hang out because you got a lot below the surface that you've
Yeah.
done that we're going to try to share with people. But before I do that, you were going to say something.
Well, I was just going to say, Mark, you mentioned history, and I think one of the benefits of that we have, that everyone can have by reading, is history. But I have access to some amazing people to teach me, like I don't know if you know Chuck Royce, but he's one of the pioneers of small cap investing,
Yeah.
famous long term small cap investor, and he
Yeah.
started his firm in the '70s. And when he started, he he had to take the train, take Amtrak from New York to DC and go to the Securities and Exchange Commission to copy the pink sheets so that he could price his portfolios. Like, that's how little information was available. And small cap stocks were considered, see if this sounds familiar, low quality, too speculative, not necessary. Why do you need to invest in small caps when you have these high quality companies available? So institutions had no interest in them. There were no indexes available to, to benchmark yourself against. There were no allocation buckets from consultants, et cetera, et cetera. So when I was thinking of launching Runa Digital Assets, I went to talk to Chuck about that. And it's so hard to experience the emergence of a new asset class because it only happens every, I don't know, 30 or 40 years or 50, I don't know, but many, more than maybe a generation. So I think but if you look back through history, it does happen periodically, and the emergence of a new asset class is generally very important to investors, to future returns. And I think that's what we have in digital assets.
Well, you gave me a layup there to go where I wanted, which is some of the work that you've done, which, it's proof of work. We can talk a lot, and as we said, some people like to just sort of assert and say stuff, and then Shazam, there's nothing behind the curtain when you go open it up, and then, joke's on you. But you've written it, you've published, and what I love about searching for different people is I never heard of Carlotta Perez before. So I'm going to raise my hand and say, didn't know about her. And what we're hopefully sharing here is something that I think you wrote about. And I don't know if you want to sort of share with how you found it and how it's relevant to what I think you just spoke about with information.
Well, Carlotta Perez, she wrote this book, which is very small, but it's called Technological Revolutions and Financial Capital. It's very small but dense, but it is a book about concepts, as you mentioned before, Mark. And it is, the subtitle is The Dynamics of Bubbles and Golden Ages. But in it, it's rooted in data, but it's more, she attempts to describe how technology creates revolutionary ages that impact not only investors, but society, all of the way all of us live and the governments that we have and regulations, et cetera. So in this book, she goes back to the Industrial Revolution and goes from there, and she observes, she tries to sort of lay out a number of different technological ages, each of which is, roughly 50 years in length. That not perfect, but roughly. And she points out that there are in each of these ages, there's several big technologies, often interacting with each other. So not just one, but usually several, that end up first disrupting, causing enormous disruption of speculation and corruption. Corruption is, a common feature of technological ages, but ultimately leading then to regulation and a golden age of enormous value creation. So she lays out these, and I think the final one, the information age, will be familiar, I think to everyone watching this. But if you notice, 1971 is about 50 years ago, and so I think Carlotta Perez thinks, and we agree, that we're likely entering a new technological age. And so we think that's important for a number of reasons. But for investors, I think, Mark, you and I talked a little bit about this, but why do investors care about this? If you look at all the companies that were public in the 90 years from 1926 to 2016, there were 25,000 plus companies that were public. And of those 25,000 companies that were public, they created a total of $35 trillion of value. I mean, these are just big numbers. But 5 of those companies created 10% of that total 35 trillion in value, and 90 of them produced more than half of it. So you think about that, 25,000 companies, and 90 of them were responsible for more than half of the value creation, and all the other ones returned less than T-bills, which is a remarkable stat, right?
Yeah. And
this is, these are called sort of fat tails of distribution. I know you're both familiar with them, but what that means is in distributions that have fat tails, a very few things produce the majority of the returns, and that's certainly what happened in equities. So you'll see here, these are the five that produced 10%, and they were the top, value producing companies of this whole time period. And you'll notice each of them started at the beginning of one of Carlotta Perez's technological ages, and some captured two. IBM was, able to ride the wave of two of these ages. But it sort of speaks to the importance of being in early and getting the benefits of that compounding for the entire period of the technological age. So I think, if we went around as I did to my family and asked them, what do you think is one of the most valuable company in the world at the time? Now it's NVIDIA, I think, but it was Microsoft. And I think that surprised a lot of people because Microsoft seems to them sort of like old tech, maybe, but one of the great advantages of Microsoft is it began as Apple did, right at the beginning of the information age. So I know where I'm going with this, but we believe we're in a new technological age. It's likely AI is certainly a huge disruptor that is part of one of those dominant technologies. We think blockchain is too, and we think Bitcoin is the OG. It is the it is the asset that is at the beginning. It in fact created the asset class, and so that's one of the reasons we're so bullish on Bitcoin. It is we think one of those dominant assets that will be one of the biggest value creators over this very long period of this new technological age.
At Onramp, we believe that Bitcoin is the most important asset of the 21st century. The hard part is securing it right. There are shortcomings with keeping your coins on an exchange, but also with setting up your own self-custody arrangement. Onramp solves for these concerns. Our multi-institution custody solution maximizes security and minimizes counterparty risk, ensuring that your Bitcoin remains securely in your possession, and provides built-in inheritance planning to ensure your family is protected as well. Onramp provides peace of mind for your Bitcoin journey, whether for your whole stack or for part of it as a complement to your existing self-custody setup. For more information, check us out at onrampbitcoin.com.
Yeah, and what we're showing here about the fat tail, pardon my watermark over some of the labeling here. Traditionally, when people think of distributions, they think of kind of like normal distributions. Like gold has a relatively normal distribution, a little bit probably skewed, some good numbers, some bad numbers, around a 3% mean. You're looking at the last 5 or 7 years of returns distributed in a histogram. But equities, believe it or not, in the aggregate, when you lump in those 25,000 companies, right, or the 500 in this Bloomberg large cap, which is like the S&P, we know that 7 have done very well. But when you put everybody in there, it kind of pulls the index a little bit to the left more than it does to the right. There's more numbers on the downside, and bonds in particular, which we've talked about. Just there's no way to turn that frown upside down when you're buying bonds these days because there just aren't as many buyers. So back to data. I mean, Carlotta wrote it, you popularized it, and Bitcoin is demonstrating what a fat tail looks like. And as you said, it seems like the being in that beginning of the revolution is a key component. And, we started out the conversation, what's going on? That maybe is why Microsoft is getting in, because they're not happy that MicroStrategy added 4 years before they did and now leapfrog them on wealth creation, on being a more optimally created or vehicle for wealth preservation and creation. It's like, and what we love about these calls with Rich is like we never know where we're going to go, but we just the key is like Bitcoin, like getting the right ingredient, and getting you on here. It's just spurring all sorts of ideas for us.
Right.
Yeah, I agree. I think Bitcoin, I think MicroStrategy, one of the great benefits of MicroStrategy, even if it's controversial, is I think the numbers are now so compelling that you really, even the skeptics have to decide, I need to learn about this. That's I think the great benefit of what Michael Saylor is doing. So I think Microsoft, they may fight it now, but I think eventually other people, I'm sure you saw, I know you know this, but Metaplanet in Japan is pursuing now a strategy, and it appears to also be doing so successfully. So I think that's going to get harder and harder to ignore. And I think
Yeah.
eventually, I think Microsoft, I hope, will start to link back to that Bitcoin really is part of a new technological age, there's no more natural place for Microsoft to go than to look to dominate a second age as IBM did in the past.
Yeah, and it's interesting. Right before the call, I'm a junkie, right? Like I'm constantly scouring for interesting videos and news items and things on that nature. And right before we, joined together in the green room, I saw a Michael Saylor video where he was basically outlining why Apple ought to solidify their balance sheet, and and it's a pretty compelling, 60-second clip, and I was just like, man, that guy really, really has done his work. There is no doubt about it. And we're already seeing all of these small and mid-sized companies starting to think about solidifying their balance sheets, with Bitcoin, which I think is really exciting, because that does so much for small businesses not to be, thinking about how to preserve their wealth and retained earnings and things on that nature, but they can actually focus on their business and their clients, while their assets are keeping up with the debasement of currency or money supply. So, that being said, it's a fascinating period of time to watch what's happening, not just in the corporate space with balance sheets, but also nation states, right? I mean, I saw you had the BRICS are potentially threatening to purchase Bitcoin in significant ways. That could be a game changer in terms of reserve assets, for currencies and things on that nature. So there's so many fascinating things that are happening in Bitcoin. One of them is ETFs. And I know that you've been paying attention to that space, and maybe share with our audience, because I know that it's something that they're paying a lot of attention to, not just looking at 13F filings, but just in conversation that I'm having with a lot of the different registered investment advisory firms, and they're all paying attention to the ETFs, and they're contemplating ways to enter the asset class on behalf of clients. So I'd love to hear your thoughts there on that disruption.
Back in 2023, in the summer, when the the great SEC lost its battle with Grayscale about the filing of a Bitcoin ETF, when the judicial system, the courts told the SEC that they're continuing to deny an ETF for Bitcoin, spot Bitcoin, was arbitrary and capricious. We,
Yes.
and I think many others, sort of sat up. I liken it to like prairie dogs in a like,
Right.
like, whoa, what this is. We, at the time, we wrote, I think this is the most important thing to happen in digital assets since Bitcoin. Like, it was, we thought it was so important because the two reasons we thought it was important. One was just the reputational risk of buying Bitcoin at that time, given the SEC especially being so hostile towards it, is so high. Where with that change with Bitcoin ETFs, we believed, and this has happened, that companies like Franklin Templeton and Invesco and Fidelity and BlackRock are all, especially Larry Fink's been very, vocal, as has Jenny Johnson, Franklin Templeton, out there really making the case for the asset class. So I think the reputational risk, they are really bringing down that significant reputational risk. We thought that would happen. And we also thought the rest of the world now finally could, through their brokerage accounts, invest in Bitcoin. And so we'd really move from the early adopters who I think are own Bitcoin right now, the sort of innovators and early adopters on that sort of classic technology adoption curve. And, the big numbers start to come in when you get into the early majority and the late majority. And I don't think I think we're just sort of getting to the early majority now. But we thought this is going to push us across the chasm to the early maturity. And that's where most technologies die because they never cross that chasm. Anyway, fast forward a year, the Bitcoin ETFs, I think we got the reputational benefit. These are the most successful ETF launches of all time.
Yeah.
Mark, you probably know these numbers better than I do, or maybe Rich, you do. But I think of ETFs for the year. The top 5 ETF launches for the year, like 4 of the 5 are Bitcoin ETFs, or something like that, and they're they're rivaling in size the largest ETFs in the markets already. They haven't been out for a year. So I think we really did get that reputational benefit of those really big credible firms out there, talking about and educating people about Bitcoin as you are. But I think we didn't get the second. BlackRock did a study of people who bought their Bitcoin ETF, and the study said only 20% of buyers were 13F filers, those institutions that have to file 13Fs about their investment activities. So 80% were not. They were more individuals or smaller wealth offices. So only 80% were not institutions, and then of that 80%. 80% of them were, this was the first time they bought any iShare product, according to BlackRock. So these were like completely new buyers, which maybe that's good from BlackRock's point of view. But from my point of view, it's like, wait, I think these are people like me and you and
Right.
March and Rich and Jennifer are the ones who bought the Bitcoin ETFs. And I bought them for my, children, for my retirement plan, things like that. So, so I think we did not yet get that early majority through the ETFs based on the data that BlackRock has given us. I don't know, is that what do you think based on
Yeah.
your reading?
Yeah, I think it's evolving quickly, which is good. The number of firms that I'm talking to are all in some level of due diligence, which is a healthy thing, right? Like they're giving the asset a little space, and they're trying to recognize, okay, how do we bring this forward to our client base? How do we do it thoughtfully? What are the risks that we need to consider? Custody in digital assets is very different than what we have come to experience as custody in traditional asset classes. So how do you mitigate those risks? And what are the best types of products and solutions to enter into the space? But you also have other elements too, right? It's not just a regulatory framework that they're looking for more, teeth that gives them that air cover. They're looking for partners too, and they're trying to figure out who's going to help us, be expert in the space because we are financial advisors and we are getting paid by our clients to have a point of view, and so they're really trying to build the competency. They're trying to, work with their compliance partners. In fact, I think in the next month, Mark, you and I have a compliance firm that will be joining us to talk a little bit about how they're guiding and advising the advisor in approaching the asset. So I think that there's a lot of moving parts, right? It's making certain that they've done their level of due diligence, that they've skilled up their organization to be able to talk intelligently and answer questions of end clients. And they're looking for some level of air cover, a true partner that, is providing them with sound investment counsel. And asset management firms will produce a lot of things for a lot of people, but it doesn't necessarily customize to the RIA level. And that's one of the challenges I think that they're facing. So just some thoughts there that I have. I'm curious, do you have observations there, Mark or Jennifer?
Following on what Jennifer said just prior about the ETFs and about 20% were filers, that's definitely green space. And, talking about you and or Bill Miller and Fidelity being the only two institutions on this odd Dutch auction for something called Google, which, yes, there
Mm-hmm.
was a broad field. It reminds me of, we just did a report on Bitcoin's unique quality of fat-tailedness that you mentioned about its ability to reduce risk and add return. And the opening quote is from Gibson about the future is here, it's just not evenly distributed. In that the ideas are there, but we got too much going on, and we're a mile wide and an inch deep. We really can't take everything in. So I think when we looked at what was the university that just the first
Emory.
endowment to add Bitcoin?
Emory.
Thank you, Emory. And $11 billion, 15 million, only 0.1%. But that may be the little bit of that might be potent enough, because SWIB did that too. State of Wisconsin added
Yes.
just 0.1%, which was 150 million for them because they're bigger. So it is 20%, but it was zero a year ago until Judge Rao's decision, which you just love the fact you call it like prairie dogs. That's maybe the best image I've ever heard to a reaction of a legislative brief dropping. Because you're like, she said, how many times did she say arbitrary and capricious in her 21
Capricious.
pages? That image, because my head popped up too. I'm like, is anyone else seeing this? It was like a bugle blaring that no one else was hearing. So, um, before I get to what Rich was saying, yeah, I do think the arc of adoption's there. It's proven. It's not a
Yeah.
tulip bubble, which was 3 years. This is 15 years. Hasn't been broken, proven. It's just transforming. So on the part about compliance, Jennifer, maybe if you spend a few minutes talking about, we talked a lot about what you did, and now what are you doing, and how did you start a digital asset firm, going from all that support at your prior firms to now doing this? What were the hurdles, and what can you share with other advisors?
Well, there are hurdles still, and that's natural. Yeah, you think about one of the things I like thinking about was like the auto industry, like the first automobiles were invented by bike manufacturers like in the late 1880s, 1890s. And you think about it, then they had to manufacture every single component themselves, like the tires, the the carburetor, any component they had to manufacture themselves. There were no suppliers. There were no roads that were automobile roads. There are no gas stations. You had to buy gas at at the drugstore. It was sold in like a quart container. There were there were so many things that prevented adoption of automobiles, and yet and what really accelerated it was assembly line technology. When Henry Ford combined the automobile with assembly line technology, that's when everything took off. So I think what I'm expecting is we have all this stumbling around that we experience too in trying to start up our own firm. We have all the same concepts as traditional finance firms. We have a custodian and a prime brokerage relationship and trading relationships and an administrator, but all the mechanics, the technology, everything is different. It's all different rails, we call them, I think. The when you come from a traditional finance background, as I do, the concepts are very familiar, but the mechanics are not. So my partner Max he's our chief operating officer, and he plows through all this stuff. But getting that up and running, getting a bank account, banks are not anxious to serve, digital asset firms. That was a challenge. In fact, the first time we sent money to Coinbase, our bank reported us to the FBI for money laundering. So
Nice. You can't catch a break.
fortunately, what's funny was the FBI agent in the Baltimore field office told me, "Don't worry, I'll explain it to them." Like he understood what we were doing.
Right.
So there were lots of obstacles. Many of those things are being smoothed out now. They're getting better and better all the time. But it was a big challenge before. So I think there's some opportunity there where we can, on behalf of investors, take care of a lot of those things so they don't have to. On the other
Right.
hand, I think it prevents a lot of innovation that could be happening, if a lot of these frictions, didn't occur. So I think there's still a lot of friction out there, and I know you both know this, but we all lament this sort of the user experience on digital asset rails, and crypto is still pretty confusing, and for many people more than they want to get into themselves.
Yeah. Yeah. It's interesting. Not only do I speak with a lot of registered investment advisors, I'm speaking to a lot of custodians and, in traditional finance, and they're all trying to pull together a cohesive way to think about the space, right? And more importantly, what is their role, that they have. So like oftentimes when I'm speaking with the RIAs, they're like, hey, look, yeah, I know you know all of the custodians. Where are they at in this space? Like until
Hmm.
they enable, I feel like I'm hamstrung and I have to
Hmm.
work in completely unfamiliar grounds. And so very similar to what you were describing there, Jennifer, you know, opening up, various relationships with, frankly, what are new or fairly, startup type of entities. Now, they may be very bright people and very capable technologies and platforms, but from an experienced eye, you're taking a bit of a chance, and so they get a little bit nervous. And I think that that's your experience is what a lot of my clients are experiencing today, which is doing the right level of due diligence, not just on the asset and the space, but who am I working with? Who am
Yeah.
I working with, and are they credible people? And so that's half the battle. But I think traditional custodians are really trying to figure out who they are, what their point of view is, what their value proposition is, and how to integrate those rails that you were referencing.
Yeah, that's where we really need this legislative action or some help from regulators. Bank regulators are really making it impossible for banks to have meaningful, um, offerings in digital assets, custody, and other things. But you're right. Many people we talk to, they want that custodian to be a household name. They want that to be the
Yep.
custodian they know will be there through thick and thin and will help them if there's a problem. And there's not a lot of choices. There are a few, but not a lot of choices there right now.
Yeah.
Yeah, for
So,
the
oh,
oh,
go ahead,
go
Mark.
ahead, Rich.
I was just going to ask. I mean, Jennifer, you've had significant leadership roles, right? CEO at Legg Mason, COO at Western. I mean, huge firms, very accomplished firms, and part of your job is being able to kind of cast forward a vision of where things are going, and you're in the heart of it in digital assets with Runa, and I'm fascinated to hear from you. How do you see the next 3, 5, 10 years playing out? Not just in traditional finance, but also in the digital asset space with this emerging asset class.
Well, two things. One, I think that one of the things you hear from asset management firms is that how little organic growth there is available for asset managers, or at
Yes.
least especially in the United States. But there's a real struggle. This is why you see them branching out to private credit and private equity and other things, trying to find growth areas. So I think one thing that will happen is, I think, as digital assets become more understood by regulators, by legislators, and we get more clarity there, that we will come to this. Carlotta Perez describes it as a golden age of really getting a value, out of these, rather than having corruption and disruption. We're going to have, a legislative framework and a regulatory framework, and really the big, firms can also and will also participate, because it is a growth area that's available, and they're so hard to find. So I think the firms that are early, especially like Franklin Templeton and Fidelity, were very early to this. I think they'll have a big advantage because they have so many people working on this. That, you mentioned an iceberg. That's how they are. There's so many people internally that have been working on it for years. So I'm expecting them to, provide to some asset managers really will get it and catch that growth wave. So I am expecting that to happen. But I'm also expecting in digital assets, there are already, I don't even know how many digital assets there are because of meme coins and things. There's like hundreds of thousands of digital assets already. Um, so they're just, people call it a Cambrian explosion. It definitely is that. And that's common in a new technology to have a lot of experimentation. So you have all these different, there used to be back to the car analogy, there used to be hundreds of car companies in the United States until you sort of coalesce on sort of who the winners are, who's got it right, who's put the right combination of technologies together. So I think that we'll see that in digital assets. Most will fail. We invest with the idea that almost everything will fail. Only a few will survive. I think Bitcoin is clearly, a survivor. I think Ethereum is too. Maybe you'd put Solana or Uniswap in that category, but beyond that, it's all a big question mark. I think it's TBD, which is typical. But I do think one interesting thing that I think is coming around now is AI dominates everyone's thoughts, especially investors. AI is why that Magnificent Seven is really outperforming everything else, and I think the promise of AI is so big. That's why I think investors are having trouble even gauging how big it is. But what AI needs, the support that it needs, kind of like the auto business and the assembly line. Maybe the assembly line isn't that sexy, but it was critical to the development of the auto industry. It was also, by the way, how IBM started, was applying that technology to typewriters. So I think that's what will happen with blockchains and AI. I think AI has some problems about how do you establish what's real, provenance, where did something come from, how to stamp something in a way that can't be faked, how to have AI agents that can make contracts and do transactions, all those problems that people are already seeing in how to make AI do the fantastic things that we want it to do. I think blockchain and Bitcoin are essential technologies for that. So they may not be as visible or as sexy as AI, but they're essential. So I think that sort of connection, people are going to start making that much more overtly.
I love that layering you did of the collapse in the time of the 100-year-old assembly line to the integrity of Bitcoin maybe being a Gresham's law manifest in AI, where they choose the most integral currency to play on as they scheme together to create money like Anderson's project, This stuff is moving fast here.
It is. That's why I love it. Every day we wake up, there's some big thing that's happened, right? That none of us anticipate. So
Rich and I were talking before. I know we're running up close, and as Rich said, we were going to break all barriers because we had you on here on time. Rich, we were talking about old tools and new toys, and when you started your firm, Runa, were you able to port over existing metrics and tools to assess the behavior or portfolio of a pool of assets that would help use a familiar lens that people could then say, oh, I know what this looks like, change it. And so all of a sudden they can see the behavior of what you're doing.
yeah, so you mentioned I have a CFA, so I have sort of all the classic training in valuation work and securities analysis. And all that stuff is very relevant, but it isn't immediately applicable. So there are a few things like Ethereum that have significant revenues, billions of dollars in revenues. They have profits. They conduct things that look like dividends or stock buybacks. And so you can cast some of the more mature assets in a light like that. But most of them they're much more like venture capital or like something completely new than they are like familiar equity analysis. So we take the ideas that are familiar from sort of classic investment ideas, but we have to come up with new tools. So one of the things we found was, for example, we think an important difference between digital assets and other assets is that they're networks. And so if you there's a law called Metcalfe's law that, it's not a real law, it's just an idea. But the idea is that, and there's a lot of data to support this, that network value grows faster than the network itself grows. And one of the implications of that idea is early networks tend to, all things equal, dominate because they have more time to make connections, which makes their value grow. So we think that's a really interesting idea. And we took, Facebook, we looked at the value of Facebook. And, you can look at Facebook's revenues and earnings and also cash flows and all sorts of metrics, classic metrics. But if you just regress Facebook's price against its growth in the network, number of participants on Facebook, that explains 94% of Facebook's price action. So it's pretty much like it's a network. That's it. That's the answer. And the same thing is true of Bitcoin. So if you regress Bitcoin price action against Bitcoin wallets, for example, or Bitcoin participation in the network, that explains 91% of Bitcoin price action. So for us, concepts like Metcalfe's law are not, they're certainly familiar. Like the top company, those Magnificent Seven companies, almost all of them are network effects companies, but that idea is still not very talked about, but it should be. And I think that that sort of thinking is what the kind of thing that we're bringing to digital assets, because I do think we need some new metrics and new ideas, because these are different. They're not equity securities and, on different technology software.
I got to say, first off, Jennifer, that was a great description. Oh, geez, Mark, I was just going to give you a kudo.
Hold on,
that was a great descriptor, but Mark is getting quite good at flashing slides, and his timing and sequencing is just really good, Mark. So a little kudos to you. But yeah, this is a really interesting slide here. So maybe you were just kind of describing it. I didn't mean to talk over you if I did. So you've got Facebook here. We're at 94.46. Is that right?
Yeah, that's the R squared on regressing Facebook's price with its participants in the network. So it explains 94% of its price change. So, and you can see on the right, same thing with Bitcoin. It's very high R squared for Bitcoin as well. And that's really the implication of Metcalfe's law. If Metcalfe's law is a valid concept, you should find this sort of result, and you do.
Yeah, and linking it back to a concept, applying it to TradFi, which something that obviously broke the barrier, what Facebook did, one of the biggest networks on the planet. And one reason why we have you here and what we try to be, besides the Muppets in the balcony, casting aspersions upon people not adopting digital assets, it's really to be that bilingual animal, to be able to speak to both. And you did it perfectly in this slide. I can't believe it took me this long to bring it up, Rich. Tell you the truth.
Yeah, this is such a powerful slide. And Mark, kudos to you too, because you're doing some really interesting research as well, which just, I think, we spoke about last week when we had Fidelity Digital Assets, Chris Kuiper, head of research there, join us. And the work that you're doing on volatility, it's really, really helpful, I think, to the larger investment community who's saying, okay, how do I lean into this a little bit with things that are familiar? And so, Metcalfe's law and the work that you did with good vol, bad vol, and really compelling stuff. And it's and I'm grateful to both of you for helping people figure out different ways. Everybody comes to Bitcoin differently. I come to find, and you guys are helping bring some familiar ways for investment advisors forward. So thank you. Well, that being said, we're at the top of the hour, and we had a chance to meet with you, Jennifer, over the weekend, and I knew the second that we started talking, my goodness, we're going to be in for an hour. And we normally go for 35 minutes, try to keep it short and sweet. But, your insights and your sets of career experiences and the journey that you've had into digital asset space is rare. And it's very, very valuable to our audience, who's grappling with how do we bring, digital assets or Bitcoin forward to our clients in thoughtful and prudent ways. And so we're just overjoyed to have you and grateful for your time and the work that you're producing in the community to help others, see the opportunity with a clear lens. And so thank you so much for joining us today. Any closing thoughts on how people can find you, Jennifer?
We do. You can find a lot of our work at our website, runadigitalassets.com. And Mark and Rich, thanks for having me. And I'm really enjoying what you're doing. So keep it going. I'm following along with great interest. I think especially Bitcoin is especially important to really developing the whole space.
Awesome. Well, thank you
Thank
so
you,
much
Jennifer.
for joining us.
Pleasure was ours.
Thank you.
Thanks for listening to this week's episode of the show. If you found the information valuable, please share the episode with a friend or leave a rating on your favorite podcast app. All the links we discussed in today's show will be in the show notes inside your podcast app. Before we finish, a quick reminder that Onramp Media is for informational and entertainment purposes only, and nothing should be construed as investment or legal advice. Regardless of where you are on your Bitcoin journey, we'd love to hear from you. Visit onrampbitcoin.com/contact to schedule a consultation with one of our private client advisors.